So the last topic that we will cover for this particular chapter is a related party, which is audit of related party transactions. This is one of the most riskiest and most important part of the audit procedures, because related party is plays a very key vital role in terms of the transactions and the risk for the auditors as well. In some audits, related party transactions are considered to be significant risk as well, or in some of them they are considered fraud risk as well. So who is a related party and what are related party transactions? First, let's understand. Related party are party which has ability to control the other party or exercise significant influence over the other party in making financial and operating decisions. So if there is a business, the shareholders are related party for the business because the shareholders controls the business. The directors, the board of directors who are taking day-to-day management operations decisions are a related party for the business. The sister concern of the entity are the related party so sister concerns, like for example, if there is a group entity has two companies within them, subsidiaries. Both subsidiaries will be related party for each of them because they have a common parent. So and any transaction with the related party are considered as related party transaction. You would have learned what is control and significant influence. Like control is where ownership of more than one or half of the voting power, like owning 50% shares of the company, is a control. Substantial interest in the voting power or power to direct. If the company has a powerful effect to direct the company, then it is a substantial interest in voting power and power to direct the company. Significant influence is where they don't have control, but they can participate in the financial and operating decisions. They can influence the directors of the company to take rational decisions accordingly. Significant influence may be exercised through representation on board of directors, participation in policy make process, material intercompany transactions dependent on technical information. Generally, significant influence occurs when there is 20% more than voting rights, then or shares purchase. If the company's shares is purchased for more than 20%, then there is significant influence. Now, as per IAS 24, the related party relationships involve with entities that are directly or indirectly controlled or are controlled by or are under control or common control with the reporting entity. So if we have a reporting entity A, then the reporting entity A will have shareholders who will be controlling the entity. The A entity will be a subsidiary. There could be a parent entity who will be having direct investments, etc. So related party relationships are the relationship between the entity A and its parties who are related with. It could be entities that are associates, like A company having an associate, let's say B company. Now A and B are related. So if A and B does some transaction, that is a related party transaction. If parent company of A and A does a transaction, that is a related party transaction. If shareholder and A does any transaction, that is a related party transaction. Individuals owning an interest in voting power of the reporting entity that gives them significant influence and their close family members. So if individuals have an interest in voting power for the reporting entity, so they have a significant voting power of the reporting entity that gives them influence and the close family members. So close family members, let's say there is a shareholder 1. Shareholder 1 has, let's say, 50% of voting rights. So he is having a significant influence over the company. More than significant, he is having a direct control over the company. Even if he has 30%, it's a significant influence. So if A and the shareholder 1 does transaction, then it's a related party transaction. Even then, if shareholder 1 has a wife, a spouse, and the spouse and A does a transaction, that is also a related party transaction. So close family members of shareholders or key directors, key management personnel are all related party transactions. Transactions with key management personnel like directors, officers and their close family members as well. Like if the entity does transaction with the director's wife's company, then it's a related party transactions. Entities in which substantial voting power by any person described on which a person is able to exercise significant influence is also a related party relationship. But those relationships are not related party relationships where there are two companies simply because they have a common director. So there could be executive director could be common for both companies. Just because of that, it's not those both entities are not related party entities. But if there are common shareholders, let's say I am a shareholder, I have company A and company B. I have 30% control over company A. I have 60%, 70% control over company B. Then we are all under one group, right? A, B and myself are under one group. I am the parent, A and B are my subsidiaries and associates. So if A and B then does some transaction, that will become a related party transaction. But directors are not shareholders. They could be not necessarily be shareholders. They could be board of directors without ownership as well, or less than control ownership as well. So just because the director is he's a executive director of one company, but non-executive in another company. Now those two companies will not be a related party. Providers of finance like banks, trade unions, government departments are not related party transactions. Single customer, supplier, franchisor, they are not related party. They are not related party relationships. They are not relationships with a related party. So what is the issue with the related party transactions? What is the problem? So firstly, the effect on the reporting entity. Related party relationships are normal feature of the commerce and business. However, a related party relationship could have an effect on the financial position and operating results. Like related party transactions is common, like it could happen. But the problem is the manipulation of those transactions. Or just because it's a related party, we are doing the transaction. The intention is wrong. No. Related party transactions that could occur due to a normal course of the business, that's fine. For example, paying salary to a director. That's a normal course of business. But just because he's a related party, giving him extra benefit, that's not correct. That is not appropriate. I'll give you an example here. Entering into transactions which unrelated parties would not. Let us say, for example, I have a company. Just because, it's my company, I hire my wife and give her salary. So now it's a related party transaction with the entity and my wife. Why? Because my wife, if it was not my company, she might not get hired here. But just because I am the owner of the company, she's getting hired here. So that is a issue with a related party transaction. Transactions not at the same terms for unrelated parties, like not at the arm's length price, where you are doing with certain sister concerns or parent entities, you might overprice it or underprice it to get either party benefit is a related party transaction. Even if related party transactions do not occur, more existence of the relationship may affect the transactions with other parties not to engage. Example, parent instruct a subsidiary not to engage in a research project. So even if related party transactions do not occur, mere existence of the related relationship may affect the transaction with other parties. So we might ask with our influence, we might ask the subsidiary entity not to go do this particular transaction. That itself shows an effect. Methods for pricing the transactions. Where relevant, methods for pricing related party transactions should be disclosed in the notes, like how the prices have been calculated have to be very clearly disclosed. So IAS 24 says gives a detailed explanation on the disclosure that the related party transaction have to be very detailedly explained in the disclosure. No details can be missed out. Significant shareholders have to be mentioned, with the major state shareholding have to be mentioned. Associate entities list, firstly identify them and list all the related parties, etc. We will study that in a short while. Further to that, what are the transactions at what prices you are doing those transactions should also be very clearly mentioned. Methods could be comparable and uncontrolled price. Price of comparable goods sold economically compared in comparable market to a buyer, unrelated seller. Like what is the price at which you are selling the product at a common market? is the number one thing that you do when it comes to related party transactions of the prices. Resale price reduced by a margin to arrive at a transfer price. So you can fix a price which you're gonna do a transfer price. Transfer price is the price between which the transactions are done between related parties. That's a transfer price. So what is the maximum price at which you are selling it to the retailer? Reduce a certain margin, you can have a transfer price. But transfer price, the standard does not say that you have to be at the same price which you are selling to the retailer, but it should be arm's length. Some difference, some discounts you can give, because it's a related party. Some discounts you can give, but you cannot give it at a huge discount. All right. Cost plus method, arrive at the cost plus the method, cost plus the markup that you are normally charging. That method also you can arrive. No price, free of provision for the management services and interest-free credit. That is also accepted to a certain extent. So the related party transactions, when it comes to the disclosures requirement, okay, the following are the examples of the related party transactions that should be disclosed. Purchases, sales of goods, property and assets between the related parties, rendering or receiving services, like providing certain kind of services, like directors providing employment services, transfer of research and development, agency leasing, finance services, guarantees, compensation of key management personnel and management contracts. These are the examples which should be disclosed for the related party transactions. And when it comes to disclosures, firstly, the related party transactions, when it comes to disclosures, the first step is to identification of the related party. All the related party relationships have to be identified and disclosed. IS 24 very clearly states that disclosures are required, may be satisfied by complying with other ISAs as well. So other ISAs have certain elements of IAS 24 where they are explaining those disclosures. Related party relationships where control exists must be disclosed irrespective of whether they have been related party transactions, so a reader can form a view about these effect of the relationships. So if there are key shareholders, the shareholder details have to be mentioned. If a shareholder is more than 50% ownership, those shareholder details have to be mentioned in the disclosure, irrespective of whether a transaction between the shareholder and the entity have been incurred or not. That has to be mentioned. If there have been transactions between related parties, the nature of the relationship, elements and their elements must be disclosed. Elements could be indication of the amount of the transactions, proportion of outstanding items, and what are the pricing policies. So firstly, all related party transactions have to be identified. Related party transactions with key stakeholders or key shareholders with significant control have to be very clearly mentioned, irrespective of whether the related party transactions have been occurred or not. Second, when there's transactions with a related party, the nature of those relationships and the elements should be disclosed, where we are indicating the volume of these amount of these transactions. Proportion of outstanding items should be mentioned, and as well as pricing policies should also be very clearly mentioned. So the next is auditors' responsibilities in relation to the related party transactions. So auditors' responsibilities are very clearly mentioned in standard ISA 550 related party transaction. It is one of the most important standard, and as I told you, the risk related to related party transactions are very severe. Now let's first understand what is the risk of related party transaction. The risk is majorly due to risk of fraud. So there is fraud risk and in terms of related party transaction, and as well as there could be significant risk as well. Fraud risk in relation to the amount and volume and nature of the transaction. Significant risk due to identification of related party. If there is a company which is having lot of transactions, it will be very difficult to identify those transactions with whom they have done it. Have they done it with a related party or not a related party? For example, if there is a journal entry, how do an auditor can understand by looking at the journal entry with whom they have done the transaction? What if it's a transaction that have been done with related party and the auditor did not identify? So that could be a big issue. So the audit team Discussions on risk of material misstatement, whether due to fraud or error, should include material misstatement with respect to fraud or error, should include the nature and extent of entities, relationships and transactions with the known related parties. That's number one. So the nature and extent of entities, relationships and transactions with the known related parties should be should be identified. The circumstances that may indicate existence and undisclosed related party should be noted. Records or documents that may indicate related parties and transactions. And are there any risk of management override of controls or related parties should also be considered. The auditor should ascertain from the directors all known related parties which have been identified in the current year. All known related parties which have been identified in a current year. Any changes in the related parties compared to the last year. What are the nature of those relationships and nature and purpose of those transactions entered with the related parties should also be considered. So all the related party, all the known related parties should be identified and they should understand from the directors like a list of who are the related parties for the entity. Number one. Last year X related parties were there. This year these many related parties are there. What are the changes? What are the nature of relationship if there have been new related parties have been identified? What is the nature of relationship? Director, shareholder, what are they? What is the nature of transaction and purpose of those transactions should also be understood. And the auditor should focus on reviewing prior year, firstly starting with the prior year working papers for names of the known related parties. Because when you look at the last year working papers, you will be able to identify who are the related parties which were identified in the last year. With the same names, have the entity done transactions in this year, right? Or are there new names coming up? Shareholders, records and share register. Have there been changes in the shareholders? Like old shareholders have sold their shares to a new shareholder, then they could be a related party. Look at the minutes of the meeting and statutory records, which will record the directors' names, directors' details, etc., and approval of directors, etc. Income tax transactions and other information supplied for regulators, which would contain these related party disclosures and all those things. Information supplied to regulatory filing and authorities could also include the details relating to the related party, because it's important that regulators need to know these related party transactions. Statement of conflict of interest from the management, records of investments and senior management pension plans, contracts and agreements with the management, significant contracts negotiated during the period, and internal auditor reports, because internal auditor reports would also include the related party details. The reason why these identification of related party is very important, because it's very difficult, as I told you, to identify the related party, and it could incur a lot of related party which are being unidentified, and the transactions could be left done with the related parties, but we are unable to identify them very easily. What if there are certain indicators that previously unidentified related parties have been identified, and how to identify them during the current year? So what if there are certain related parties we didn't identify during the last year? Well, how can we identify them during the current year? Firstly, you can look at certain trades, sale of transactions which has happened at a normal price with huge discount or at huge margin. Have they happened? With different pricing terms, have they happened? That's number one. Lack of logical business reasons for occurrence. Certain transactions, there is no business reasons for occurrence. Suddenly a transaction comes in. Substance differs from the form. The contracts actually, what they have, mentioned in the title, but they are doing something else. They are processed and approved in a non-routine manner. Certain transactions with the certain relationships, they are done with in a different manner, non-routine manner. They don't go through a normal terms. Transactions with high volume or significance, high value transactions, have they happened? Like transfer of amounts for high value. So what we used to do is we used to take the journal entries filter with a specific amount, 1 million, 2 million. Have they happened? Unrecorded transactions, that example, services at no charge. Like the transactions would have posted, but amount would be zero. Are there cases of those? Then comes dominant influence. Dominant influence suggests indicators of dominant influence exerted by the related party. To give you an example, the related party has vetoed significant business decision by the management or those charged with governance. Like one particular director or one particular or few directors are taking major decisions and incurring significant decisions for those charged with whereby various other managements are not able to do anything. Significant transactions are referred to the related party for final approval. Like major transactions are given to the related party and for their final approval. So which means the related party have dominant, like they are taking control over things. They don't need to have like major transactions with them. The small transaction can be there because it can be delegated to the junior managements as well. There is little or no debate among management and those charged with governance regarding business proposal initiated by a related party. So related party can do anything. The shareholder can take any kind of decisions. Nobody questions them. Transactions involving the related party are rarely independently reviewed and approved. So transactions can be easily done by the related party. It's not approved by anyone. Dominant influence may also exist in some cases if the related party has played a leading role in founding the entity. So the shareholders or the founders, what do? They simply every year increase their salary from 1 crore to 2 crore to 3 crore. So that's a dominance. They are able to do it by increasing their salary significantly. In the presence of other risk factors, the existing related party with dominant influence may indicate significant risk. If there are related parties with dominant influence, it could indicate significant risk due to fraud. For example, unusually high turnover for senior management or professional advisors. Like senior management or professional advisors, they are able to get high unusual turnovers. How is that possible? It could indicate that they are doing some fraudulent reporting. Use of business intermediaries, like director's friend is running a business, they are used for a transaction which we used to do it by ourselves. Evidence of related party excessive participation in selection of policies, estimations, etc. Management is overseeing everything. They are not giving it to the junior managements, etc. All these could be lead to a fraud risk. So the next is identifying the related party transactions. One thing you need to understand is management has the responsibility to identify all the related party transactions and disclose them very clearly and in a detailed manner in the financial statements. The following may assist in the identification of related parties. So along with the management's identification, auditors should also spend time to see if they are able to identify something. Because what if the management failed to identify? Because we cannot keep quiet and say, oh, management will do it. We just have to wait and watch. No. We need to ensure that the management identifies. At the same time, we do certain procedures to help us identify the related party transactions. So for that, we need to exercise professional skepticism by scrutinizing all the documents during the course of an audit to see if there is a possibility of a related party transaction. To give an example, I was auditing a bank. We used to look at the customer KYC forms of the bank to see if the bank is doing the transaction with which customer, whether that customer is actually a related party of the bank or a director, etc. So then that will be flagged. If yes, that will be flagged as a related party. Technically, the bank should also flag it as a related party transaction in their KYC form itself. Detailed test of transactions balances, especially those that appear to be outside of the normal business terms, are processing. So we do a detailed test of those transactions and balances which could be outside the normal business terms will also have to be identified when it comes to related party transactions. Typical examples of those transactions which are considered being outside of an entity's normal course of businesses are like complex equity transactions, where they do some corporate restructuring, transactions with offshore entities in jurisdiction of weak corporate laws, leasing premises. These are not normal transactions they do, like not like sale of goods or services or providing services, etc. These are not common transactions which the entities do. These are very unusual transactions that they do. Sale of transactions with large discounts, transactions with circular arrangements, example with a commitment to repurchase. So you're doing transactions with the spouse of the shareholder saying that okay, after 1 month you will repurchase it. These are all red flags for identification of a related party. Transactions under contract whose terms are changed before the expiry, etc. Related party transactions could be identified also by reviewing the accounting records or large or unusual transaction balances. So what we used to do is we used to take the journal entries and review those journal entries and transactions to see and filter by unusual amounts and which are near to the reporting period or not. Reviewing confirmations of loan receivable and payable from the banks, which may indicate a guarantor relationships. Reviewing investment transactions, etc., like purchase or sale of equity investment interest in a joint venture, etc. All these transactions are reviewed to identify if there is any related party transactions, like loan confirmations, payable confirmations from the bank, investments related transactions, etc. And once the related party transactions have been identified, the next one is for the auditors to examine those related party transactions. Identify the related party transactions. They should be examined, whereby you confirm the terms, conditions and amounts with the related party. Inspect the evidence with appropriate authorization, because the related party transactions should also go through the same approval process compared to any other transaction. Confirm and discuss with relevant independent persons, like example banks or lawyers. Review any financial statement of the related party disclosures being made. So the disclosures, have they been made correctly, and are the related party transactions disclosed in as per the requirements under IAS 24 or not. Whether the requirements of IAS 24 have been clearly followed or not should also be mentioned. Relevant background research should be conducted. Example, internet, web-based information databases should be collected, etc. Where the transaction is considered to be outside the normal course of business, evaluate the business rationale, like what is the purpose of this transaction, why the transaction have been done with the related party. Get management explanations, with respect to the terms of the transaction. Look at the accounting which have been done and the disclosure for the reporting framework, and whether the transactions have been authorized and appropriate individuals have been approved with respect to the audit committee as well, being notified with respect to the related party transactions as well. So these are the normal procedures that the auditor will do when they have, after they have identified the related party transactions, which is going through their evidences and seeing if it is done with all proper controls in place and proper authorizations in place, and of course the proper communications in place. There will be certain cases where management fail to inform the auditors for any related party transactions. Where the auditor identifies the related party transactions or significant related party transaction, management has not previously identified or disclosed. So last year there was a few transactions, related party relationships or transactions which management did not disclose or identify. If that's the case, but auditor identified those transactions in the current year, like last year they didn't identify, so we also didn't mention anything. This year we identified it, but auditor have not, the management have not communicated anything to us. So the question is intention. Why are they hiding the fact? If there are related party transactions and they have not identified it, why are they hiding the transaction? What is the intention? That skepticism should be there in your mind. That question should be there in your mind. You should promptly communicate the relevant information to all other engagement team members to be skeptical. See, there are certain transactions which we have identified which the management did not communicate to us. We need to request to the management to identify all the transactions with the newly identified related party for further evaluation. Discuss why the control failed to identify the related party transaction. Perform substantive audit procedures with respect to these transactions, like gathering evidences, confirming the amounts of the transactions, etc. Reconsider the risk related to the related party transactions, whether any significant related party transaction may exist, and perform additional audit procedures as necessary. If the non-disclosure appears to be intentional, evaluate the implications for the audit. Like, we need to consider it's as a fraud risk. We need to reconsider the risk because, as I told you, the intention. Is the management hiding the related party transaction purposely, or are they doing it non-intentionally, unintentionally? That has to be considered. So to protect ourselves, there could be cases where related party transactions could be significant and we are unable to identify. So to protect ourselves, we always need to get management representations. Management representations, which means in written representation, we need to clearly mention that all the related party transactions have been identified and management approves that all the related party transactions have been identified and have been disclosed in the financial statements very clearly. The adequacy of the related party disclosures in the financial statements are appropriately mentioned. Where specific related party transactions materially affect the financial statement or involve management, such transactions have been approved by the management. These things have to be written in a written representation and get it approved from. Confirmation of the management's financial and other interests in relation to the related party transactions. So all of these pointers will be mentioned in the written representation, and the written representation will be given to us by the management on signed paper. If there are certain issues with the management, we need to communicate with those charged with governance. If management are failing to disclose information to related party, we would definitely need to discuss those things with those charged with governance. There are few discovery related parties which were not approved and which may give rise to a possible indication of fraud. Disagreement with the management relating to accounting and disclosures of the related party. Non-compliance of laws and regulations, and difficulties in identifying the related party due to lack of control. All these elements have to be clearly communicated with those charged with governance. And if there are disclosures which are inadequate or misleading or are not appropriate, then definitely if there are misstatements or lack of evidences, then opinion can be modified, a qualified or a disclaimer opinion can be issued by the auditor, because the related party transaction is a very important data. So either if the related party transactions are inadequate, the transactions have mistakes, the amounts of the transactions are not appropriately disclosed, etc., then it could be resulting in a qualified or an adverse opinion. But if the client is not giving us evidence at all, then we will go for a qualified or a disclaimer of opinion. So that's what about related party transactions. So you need to note these pointers, because these pointers could be discussed in terms of a 50 marker or a 25 marker question, where you have to explain in detail what are the responsibilities of the auditor with respect to a related party transaction. And as I told you, the biggest risk in terms of related party transaction is definitely the identification of the related party transaction, and the disclosure of the related party transaction is what is required to be in a detailed and adequate manner.